Bloomberg Audio Studios.
Podcasts, radio, news.
But we begin with the number one issue that's been on the mind of global Wall Street since inflation numbers first shot up back in 2020, something our special contributor Larry Summers warned us about at the time.
I think there's a real possibility that within the year, we're going to be dealing with the most serious incipient inflation problem that we have faced in the last 40 years.
Throughout the three-year battle with inflation, there's been a question whether it could be tamed without higher unemployment.
I've said that I'd be surprised if we get to the 2% inflation target without an unemployment rate that approaches or exceeds 6%.
But on Friday this week, we got the latest jobs numbers, and unemployment stayed under 4%, even as inflation continues to moderate, something that's led Larry to reassess the possibility of a so-called soft landing, one where inflation comes back in line without a lot of people losing their jobs.
Things did come back in a way that was more favorable than standard models would have expected, though I'm much less prepared to declare that it's all over.
And we are joined once again by our very special contributor here on Wall Street Week. He is Larry Summers of Harvard. Larry, thanks so much for being with us. On Friday, we got the jobs numbers out. They were a little lower than some people expected, and particularly when you look at the revisions from last month. What did you make of these jobs numbers?
I don't think they changed anybody's picture very fundamentally of the economy. We've got a strong economy. Inflation has come down. Inflation is not yet at the Fed's 2% target, but job growth, even on a slower basis, remains considerably more rapid than underlying population growth. So we've got a relatively strong economy.
Well, and that raises the question of what does that mean for monetary policy? I mean, one question we ask sometimes of people at the Fed is, why are we talking about rate cuts right now when the economy seems to be doing so well and weathering this 5.5% rate?
There's something very fundamental that has happened that I'm not sure that the Fed has fully realized. I think the neutral interest rate is way above the 2.5% that the Fed likes to talk about. I think given the experience of the last several years that the market perceives normal inflation as probably being somewhat above 2%, at least on a CPI basis. And I think that huge deficits, more spending to come, substantial investment in renewables, substantial investment in resilience, substantial capital costs of various kinds associated with artificial intelligence, an aging population, meaning more dissavers, less capital flow coming from abroad. I think all of that means a much higher neutral real interest rate. So I think when the Fed compares 5% with the 2.5% neutral rate it sees, and people say that monetary policy is substantially restrictive, that's wrong. The neutral rate is much higher than that. And so monetary policy is much less restrictive than is generally supposed. And the clear evidence of that is that we have this supposedly really restrictive monetary policy and still have a quite robust economy. So I think the Fed needs to be very careful in its judgments about what would be an epochal shift from the regime we've had for the last several years to a regime of easing monetary policy. And they've moved substantially since December. Market used to be expecting 6 cuts in 2024. Now the market's expecting 3 cuts. And the Fed's carried that off skillfully. There hasn't been much disruption or dislocation as that change has taken place. But I think that's going to be there with us for the next while. And my own guess is probably that there's a little more adjustment to come, and the Fed may end up not deciding to cut quite as much as markets are now expecting. But I do think we need to get ourselves to an idea that neutral rates are closer to having a four handle than they are to having a two handle.
Larry, you, of course, are data dependent just the way that Jay Powell's data dependent, but consistent with the need for more data. We had Torsten Slok of Apollo this week come out and say he doesn't think there are going to be any cuts this year for some of the reasons you suggest. I'm not asking you to commit on what will happen, but does that seem plausible to you?
Yeah, I think I said on the show maybe a month ago, that several weeks ago, that there was a 15% chance that we wouldn't have cuts this year. I think if anything, that 15% may have drifted slightly upwards, and markets are kind of consistent with that if you look at options markets. So I think the base or presumptive case is probably that the next move is going to be down, but I think it'd be a real mistake for people to regard that as any kind of certainty. And I think the Fed has to be really quite careful here, because I certainly think we're at least at the foothills of bubbles. To mix a metaphor. I don't think right now financial markets have the kind of bubbly characteristics that they famously had at other times, but it's not that we're a million miles away from that either. And so I think that's something that also has to inform the policymaking process.
So on the eve of the jobs numbers we got on Friday, we actually heard from President Biden in his State of the Union address. I'd be curious to hear what your take was on the economic portion of what he had to say.
You know, I was glad to see the president being as vigorous and strong as he was. Certainly, the president looked like a man with a plan. Indeed, a man with many plans and ideas and an energetic agenda going forward. And there was a lot that I heard that I liked in terms of building and investing in the strength of the country's future economy for the benefit of the middle class. I do think we need to be very careful in our country about a kind of populist tradition in economics that lurches towards big deficits, towards anti-trade international economic policies, that focuses on economic nationalism. And there's concern there on short-sighted benefits to consumers that may ultimately reduce businesses' ability to invest in the future. And so I think that's something we all need to be careful about.
Okay, Larry, thank you so very much for being back with us. That's Larry Summers, our very special contributor here on Wall Street Week.